What if I told you that 79% of Americans now believe we're facing a retirement crisis? That's up from just 67% in 2020. But here's the shocking part. Most people making retirement plans today are walking straight into a financial trap, and they don't even know it. By the time you reach 65, you could be facing a nightmare scenario where your carefully planned retirement becomes a decade of financial stress, forced labor, and broken dreams. Today, we're going to expose the 5 deadly retirement myths that could destroy your future and, more importantly, show you exactly how to escape this trap before it's too late. I'm going to share with you the latest 2025 data that financial advisors don't want you to know, including why Social Security might only pay you 75 cents on the dollar, why your home equity strategy could backfire spectacularly, and the surprising truth about which generation is actually winning the retirement game. If you're planning to retire in the next 10, 20, or even 30 years, this video could be the difference between living your golden years in comfort or spending them in financial desperation. Let's dive in. Introduction. Welcome back to Bravo Life 360, where we decode the financial realities that shape your future. I'm your host, and today we are tackling one of the most critical topics of our time, the retirement crisis that's silently building in America. Here's what we know as of 2025: more than half of Americans, to be exact, they cannot achieve financial security in retirement. That's not just worry, that's a mathematical reality. For millions of people who are following outdated advice and believing dangerous myths about what retirement will look like, the landscape has fundamentally changed. The rules that worked for your parents' generation don't apply anymore. Social Security is facing unprecedented strain. Healthcare costs are skyrocketing, and the traditional pension system has virtually disappeared. Yet, somehow, we are still planning for retirement like it's 1985 today. We are going to shatter 5 myths that could sabotage your retirement, reveal the shocking truths behind each one, and give you a roadmap to build genuine retirement security in 2025 and beyond. But first, let me ask you this. When you picture your retirement, what do you see? Beach walks, time with grandchildren, freedom from financial stress? Keep that image in mind, because by the end of this video, you'll know exactly what it takes to make that vision a reality, instead of just a fantasy. Myth 1: Social Security will take care of. Let's start with the biggest and most dangerous myth, the belief that Social Security will provide adequate retirement income. Here are the facts that will shock you. As of 2025, Social Security faces its most severe financial crisis in history. The latest projections from the Center for Retirement Research show that the 75-year deficit has jumped to 3.82% of taxable payroll, compared to 3.50% in 2024. That might sound like numbers, but here's what it means in plain English: the system is getting worse, fast. The Social Security Trust Fund peaked at $2.82 trillion in 2017. By the end of 2024, it had already fallen to about $2.5 trillion since 2021. Social Security has been redeeming its treasury bonds and using the proceeds to bridge the gap between what it collects and what it pays out. That gap is widening every single year. Here's the timeline that should terrify anyone planning to retire without legislative action. The Social Security Trust Fund surplus will be completely depleted around 2033 to 2034. That's less than a decade away. But here's what most people don't understand. Even when the trust fund runs out, Social Security doesn't just disappear. Ongoing payroll taxes from current workers would still fund approximately 75 to 80% of promised benefits. So, if you're expecting $2,000 a month from Social Security, you might only get $1,500, $1,600. Now, let's talk about what Social Security actually pays today. The average retired worker gets $1,976 per month as of January 2025. That's $23,712 per year. Can you live on less than $24,000 a year? And remember, that number could drop by 20 to 25% if the trust fund is exhausted. Even if you're married, the average couple receives $3,089 per month, which is about $37,000 per year. In today's economy, with inflation affecting everything from groceries to healthcare, that's barely survival-level income. Here's another reality check: 1 in 5 Americans receives Social Security benefits. That's over 67 million people. Depending on a system that's mathematically unsustainable in its current form. The 2025 cost of living adjustment was just 2.5%, giving the average retiree about $49 more per month. But healthcare costs are rising much faster than 2.5% annually, which means your purchasing power is actually declining every year, even with these adjustments. So what does this mean for your retirement planning? If you're counting on Social Security as your primary retirement income, you're planning for failure. Social Security was never designed to be a complete retirement system. It was meant to be a safety net, not your entire financial foundation. The hard truth is this: Social Security might cover your basic groceries and utilities if you're lucky. Everything else, housing, transportation, healthcare, entertainment, travel, all of that needs to come from somewhere else. And if you're thinking, well, Congress will fix this, here's the political reality: both major parties have been reluctant to reduce Social Security benefits and equally averse to raising payroll taxes significantly. Every proposed solution involves either painful cuts, substantial tax increases, or both. The longer politicians wait, the more severe the eventual solution will have to be. This isn't fear-mongering, this is mathematical reality. The Social Security trustees, the Congressional Budget Office, and every credible financial analyst agrees on the basic timeline and shortfall numbers. Myth 2. I'll just work longer. The second myth that's destroying retirement plans across America is the casual assumption that you can just work longer if you haven't saved enough. This sounds logical on the surface. After all, we're living longer, so why not work longer? But the reality is far more complicated and often heartbreaking. Let's look at the data that shatters this myth. According to the latest Employee Benefit Research Institute studies, more than half of retirees, 57% to be exact, leave the workforce earlier than they had planned. Think about that for a moment. The majority of people who planned to work longer couldn't actually do it. Why does this happen so frequently? The reasons will surprise you. First, health issues. As we age, our bodies don't always cooperate with our financial plans. Chronic conditions, unexpected illnesses, and the cumulative wear and tear of decades of workforce. Many people into early retirement, ready or not, you can't negotiate with diabetes, heart disease, or arthritis. When your health fails, your work life ends, regardless of your bank account balance. Second, caregiving responsibilities. Many people in their 60s find themselves caring for aging parents, spouses with serious health conditions, or even grandchildren. These responsibilities don't follow a convenient schedule, and they often require full-time attention. Third, job loss and age discrimination. Here's an uncomfortable truth that nobody talks about openly: ageism in the workplace is real, and pervasive. Workers over 50 face significant challenges finding new employment if they lose their jobs. The unemployment rate tells only part of the story. Older workers who do find new jobs often have to accept significantly lower salaries or positions well below their qualifications. A 2025 AARP study found that 78% of older workers have seen or experienced age discrimination in the workplace. When companies downsize or restructure, older workers with higher salaries are often the first to be let go, despite laws prohibiting age discrimination. Fourth, skill obsolescence. The pace of technological change means that skills can become outdated quickly. Workers who haven't kept up with digital transformation, artificial intelligence, or new industry standards may find themselves unemployable, regardless of their experience and work ethic. But let's say you do manage to work longer. What does that actually look like in terms of financial benefit? If you delay retirement from age 67 to age 70, you can increase your Social Security benefits by about 24%. That sounds significant until you realize we are talking about increasing from $1,976 per month to about $2,450 per month. That's helpful, but it's still not enough to fund a comfortable retirement without substantial personal savings. Working longer also means 3 fewer years of retirement. If you're planning to live into your 80s or 90s, working from 67 to 70 means giving up 15 to 20% of your retirement years to earn a 24% increase in Social Security benefits. From a pure mathematical standpoint, that might not be the best trade-off, especially considering that many people experience declining health in their later years. Here's another factor most people don't consider: job satisfaction and stress levels in your 60s and 70s. Many older workers find themselves in hostile work environments, dealing with younger managers who don't value their experience, or struggling with physical demands they could handle easily when they were younger. The psychological toll of being forced to work when you expected to be retired can be devastating. Depression rates among older workers who wanted to retire but couldn't afford to are significantly higher than among those who retired as planned. Now, let's talk about the flip side: people who can successfully work longer and want to. Recent surveys show that 59% of workers plan to work in retirement, and 61% of people who've been retired for 0 to 2 years are interested in some form of work. But here's the key distinction: there's a massive difference between choosing to work because you want to stay engaged and being forced to work because you have no financial alternative. One is empowering, the other is a prison sentence. If you're going to plan for working longer, you need to be realistic about these factors. Your industry's treatment of older workers: some fields, like consulting or part-time retail, are more welcoming to older employees. Others, particularly technology and many corporate environments, are not. Your health trajectory: look at your family history, your current health status, and be honest about what you might be dealing with in 10-20 years. Your skill development: are you continuously learning and adapting, or are you coasting on experience that might become obsolete? Alternative work arrangements: maybe traditional employment won't work, but consulting, freelancing, or part-time work might be viable options. The bottom line is this: "I'll just work longer" is not a retirement strategy, it's a hope. Hope is not a plan. If working longer is part of your retirement vision, make sure it's a choice you're making from a position of financial strength, not a desperate move because you have no other options. Myth 3: young people aren't saving enough. The Generation Z surprise. 14 to 20 minutes. Here's where things get really interesting, and where conventional wisdom gets turned completely upside down. For years, we've been hearing that young people don't save, that they're financially irresponsible, that they spend all their money on avocado toast and expensive coffee. But the 2025 data tells a dramatically different story. Let me share some statistics that will blow your mind. According to the investment company Institute's 2024 research, Gen Z households with defined contribution plans are actually outpacing earlier generations on the path to retirement saving. More than 3/4 of Americans younger than 35 say that the tax treatment of their retirement plans is a driving incentive to contribute. But here's the real shocker: looking at 2024 savings data, millennials saved an average of $12,004.87 more than any other generation. Gen Z came in third with $6,164.67 saved for the year. Meanwhile, baby boomers, the generation we always hold up as the model of financial responsibility, saved just over $3,400 for the year. Now, before we celebrate too much, let's dig deeper into what these numbers really mean, and why they're both encouraging and terrifying at the same time. First, the encouraging news: young people today understand that they cannot rely on Social Security or traditional pensions. They've watched their parents struggle through the 2008 financial crisis. They've seen corporate pension plans disappear, and they have no illusions about Social Security being there for them in 40-50 years. This reality check has created what researchers call retirement anxiety motivation. Gen Z and millennials know they're on their own, so they're starting earlier and saving more aggressively than previous generations did at their age. The tax advantages of 401k plans and IRAs are particularly appealing to younger workers, because they're typically in lower tax brackets now than they expect to be in the future. They understand the power of compound growth better than any generation before them, thanks to easily accessible financial education online. But here's where the story gets complicated and concerning. Despite this increased savings awareness, 60% of Gen Z and millennials still have less than $5,000 in retirement savings. Let me repeat that 6 out of 10 young workers have essentially nothing saved for retirement. Only 47% of Gen Z workers contribute to a retirement plan like a 401k, compared to 75% of millennials and 76% of Gen X. This suggests that while the Gen Z workers who are saving are doing so aggressively, a large portion aren't saving at all. Even more alarming, recent reports show that many young workers are already dipping into their retirement savings to cover emergency expenses and debt payments. They're saving money and then immediately undermining that progress by taking early withdrawals, which not only reduces their retirement funds, but also triggers penalties and taxes. Here's the bigger picture that's really scary. The young people who are saving well today are largely those with good jobs, stable income, and employer-sponsored retirement plans. But what about the millions of young workers in the gig economy, in retail jobs, without benefits, or dealing with student loan debt that prevents them from saving anything at all? The wealth gap within generations is actually larger than the wealth gap between generations. High-earning millennials and Gen Z workers are indeed saving more than previous generations, but low-earning young workers are in worse shape than ever before. Let's talk about the obstacles that even savings-motivated young people face. Student loan debt is the elephant in the room. The average college graduate today carries significantly more debt than previous generations. When you're paying $300 to $800 per month in student loans, finding money for retirement contributions becomes incredibly difficult. Housing costs have exploded relative to wages. Young people today spend a much higher percentage of their income on rent or mortgage payments than previous generations did. When housing eats up 30 to 50% of your income, retirement savings often gets pushed aside. Healthcare costs, even for young, healthy people, are higher than ever. Many young workers are choosing high-deductible health plans to keep premiums manageable, but that means they're one medical emergency away from financial disaster. The gig economy provides flexibility, but often lacks the structured retirement benefits that previous generations took for granted. Uber drivers, freelancers, and contract workers have to create their own retirement plans, and many simply don't have the knowledge or discipline to do so effectively. Here's what's particularly concerning about the retirement prospects for younger generations. They're facing a perfect storm of challenges that no previous generation has had to navigate simultaneously. They'll receive lower Social Security benefits, if any meaningful benefits survive. They have no access to traditional pension plans. They're dealing with higher education costs, higher healthcare costs, and higher housing costs than any generation in history. And they're expected to save more money than previous generations, while dealing with stagnant wages and increased living expenses. The Gen Z and millennial workers who are succeeding at retirement savings are doing so despite these obstacles, not because the system makes it easy. They're making significant sacrifices, living with roommates longer, delaying home purchases, choosing not to have children or having fewer children to prioritize retirement savings. But here's the crucial question: is this sustainable? Can an entire generation maintain this level of financial sacrifice for 40 to 50 years? And what happens to the majority who aren't able to save aggressively? The data suggests we're creating a two-tier system: young workers who understand the retirement crisis and are aggressively preparing for it, and young workers who are struggling to survive paycheck to paycheck and have no realistic path to retirement security. This isn't just an individual problem. It's a societal crisis in the making. When large portions of entire generations reach retirement age without adequate savings, the social and economic consequences will be severe. The myth that young people aren't saving is dangerous because it prevents us from seeing the real problem. Even the young people who are saving well may not be saving enough to overcome the structural challenges they're facing. Myth 4. My house will fund my retirement. Let's talk about what might be the most dangerous myth of all: the belief that your home equity will save your retirement for decades. This was actually sound advice. Baby boomers bought homes for $30,000 to $50,000 that are now worth $300,000 to $500,000 or more. Their home equity became their retirement jackpot. But if you're banking on this strategy today, you could be setting yourself up for a devastating disappointment. Here's why the home equity retirement strategy is fundamentally broken. For today's workers, First, let's look at the math that worked for previous generations. A baby boomer who bought a house in 1980 for $50,000 in a market that's now worth $400,000 saw an 8x return on their investment over 40 years, even accounting for maintenance, taxes, and improvements. That's substantial wealth creation. But here's what's different now: home prices have already experienced massive appreciation. In most markets, if you're buying a $400,000 house today, what are the realistic chances it will be worth $3.2 million when you retire? In 30-40 years, that would require the same 8x appreciation that previous generations experienced. Some areas might see that kind of growth, but many won't. And here's the critical point: you can't eat home equity. Your house provides shelter, but unless you're willing to sell it or take on debt against it, that equity doesn't pay for groceries or healthcare. Let's explore the options for accessing home equity in retirement and why each one has serious drawbacks. Option 1. Sell your home and downsize. This sounds logical, but the reality is often disappointing. In many markets, there isn't much price difference between larger and smaller homes. A retiree who sells a $400,000 for bedroom house might only net $150,000 to $200,000 after buying a $250,000 two-bedroom condo, paying real estate commissions, moving costs, and other expenses. That's helpful, but it's not retirement funding money for most people. Plus, downsizing often means moving away from established communities, family, and support networks. The emotional and social costs can be significant. Option 2. Reverse mortgage. Reverse mortgages allow homeowners 62 and older to convert home equity into cash while continuing to live in the home. But these products are expensive and complex. The fees, interest rates, and restrictions mean you typically only access 40 to 60% of your home's value. A $400,000 house might generate $160,000 to $240,000 through a reverse mortgage. More importantly, reverse mortgages can be risky for surviving spouses and heirs. If you don't maintain the property or pay property taxes and insurance, you can lose your home. And when the last borrower dies, the home typically must be sold to repay the loan. Option 3. Home equity line of credit, HELOC, or cash out, refinance. These options require monthly payments, which defeats the purpose. If you're trying to generate retirement income rather than take on new debt obligations, option 4. Rent out rooms or become a landlord. This can work, but it turns your home into a business and your retirement into a job. Many retirees don't want the hassles, responsibilities, and risks that come with being a landlord. Now, let's talk about the bigger economic trends that make home equity less reliable as a retirement strategy. Property taxes tend to increase over time, especially as property values rise. Many retirees find themselves house rich but cash poor, unable to afford the property taxes on homes they own outright. Some are forced to sell not because they want to access equity, but because they can't afford to stay. Maintenance and repair costs increase as homes age. A 30-year-old roof needs replacement. HVAC systems fail, foundations settle. The same home that was affordable to maintain at age 40 can become a money pit at age 70. Geographic risk is real. What if your local economy collapses? What if your area becomes less desirable due to climate change, crime, or other factors? Betting your retirement on one piece of real estate in one location is putting all your eggs in one basket. Here's another factor that's specific to younger generations. Today, many are buying homes much later in life than previous generations. If you don't buy your first home until age 30 to 35, and you take out a 30-year mortgage, you won't have it paid off until age 60 to 65. That doesn't leave much time for the mortgage-free years, where you could potentially benefit from having no housing payment. Even worse, many younger home buyers are taking out longer mortgages or making smaller down payments than previous generations. Some are buying with 3 to 5% down payments and 40-year mortgages. These buyers will build equity much more slowly and may never reach the point where their homes are truly significant assets. Let's also address the elephant in the room: housing affordability. In many markets, young people simply cannot afford to buy homes at all. If you're renting your entire working life, you're not building any housing equity for retirement. You're at the mercy of landlords, and rent increases throughout your retirement years. The homeownership rate for young adults has been declining. Many millennials and Gen Z workers who want to buy homes can't afford them, especially in job-rich metropolitan areas where wages are higher, but housing costs are even higher. This creates a vicious cycle. Unable to buy homes, young workers miss out on the forced savings and potential appreciation that homeownership provides. They remain renters longer, which makes it harder to accumulate wealth, which makes it harder to eventually buy homes. Here's what the math looks like. For many young workers today, they might spend $2,000 to $3,000 per month on rent for decades, building no equity whatsoever. Meanwhile, their parents spent $800 to $1,200 per month on mortgages that built substantial equity over time. But let's say you do successfully buy a home and build equity. Here's the reality check about what that equity can actually do for your retirement. If your home is worth $500,000 when you retire, and you decide to access that equity, you might net $200,000 to $300,000 after selling costs and buying something smaller, invested conservatively at 4% annual returns. That generates $8,000 to $12,000 per year in income. That's helpful, but it's not life-changing money. Compare that to the $500,000 to $1 million that financial advisors say you need in retirement savings, and you can see that even substantial home equity doesn't solve the retirement funding puzzle by itself. The bottom line is this: your home can be part of your retirement strategy, but it cannot be your retirement strategy. The days when home equity alone could fund a comfortable retirement are largely over, especially for younger workers facing today's housing market realities. If you're going to include home equity in your retirement planning, make sure you understand exactly how you plan to access that equity, what the costs and risks will be, and have realistic expectations about how much income it can actually generate. Myth 5: retirement means freedom from financial stress. 26 to 32. This might be the cruelest myth of all. The belief that retirement automatically brings financial peace of mind. The reality is that for many retirees, financial stress actually increases after they stop working. Let me show you why retirement can become a financial nightmare, even for people who thought they were prepared. The biggest shock for new retirees is often healthcare costs. Here's the number that terrifies financial planners. Fidelity estimates that the average 65-year-old couple retiring in 2025 will need approximately $300,000 just for medical expenses throughout retirement. That's not including long-term care, which could easily add another $200,000 to $400,000 to the total. Think about that for a moment before you spend a single dollar on food, housing, transportation, or entertainment. You need to have set aside $300,000 to $700,000 just for healthcare, and those numbers assume you stay relatively healthy and don't face major medical crises. Here's what drives these astronomical healthcare costs. In retirement, Medicare doesn't cover everything. Many retirees are shocked to discover that Medicare pays only 80% of many medical expenses, leaving them responsible for substantial co-payments and deductibles. Medicare doesn't cover dental care, most vision care, or hearing aids. It provides limited coverage for prescription drugs. Medigap insurance, which helps cover what Medicare doesn't, can cost $200 to $400 per month or more, depending on your location and the coverage level you choose. Long-term care is the wild card that can destroy even well-planned retirement budgets. The average cost of a nursing home is now over $100,000 per year in many areas. Even assisted living facilities average $50,000 to $70,000 annually. Home healthcare can cost $25 to $30 per hour. Most people will need some form of long-term care during their lifetimes, but long-term care insurance is expensive and has become much more restrictive than it used to be. Many policies that seemed generous when purchased years ago now provide inadequate coverage due to inflation and changing care costs. Prescription drug costs are particularly cruel for retirees. Many older adults take multiple medications that can cost hundreds or even thousands of dollars per month. Even with Medicare Part D coverage, the out-of-pocket costs can be devastating for people on fixed incomes. But healthcare is just one piece of the retirement financial stress puzzle. Let's talk about the other factors that catch retirees off guard. Inflation is the silent killer of retirement security. Even modest inflation of 3% per year cuts the purchasing power of fixed income in half over 20 years. A retiree who needs $50,000 per year in today's dollars will need $90,000 per year in 20 years just to maintain the same standard of living. Social Security includes cost of living adjustments, but they often don't keep pace with the real increases in costs that retirees face. Healthcare costs, property taxes, and utilities typically increase faster than the general inflation rate. Market volatility becomes terrifying when you're living off your investments. During your working years, market downturns were opportunities to buy more shares at lower prices. In retirement, market downturns mean your income drops just when you need it most. The sequence of returns risk is particularly dangerous for new retirees. If the market crashes in your first few years of retirement, you might be forced to sell investments at low prices to meet living expenses, permanently damaging your portfolio's ability to recover. Tax surprises plague many retirees. Required minimum distributions from traditional IRAs and 401ks starting at age 73 can push retirees into higher tax brackets than they expected. Social Security benefits become taxable for many middle-class retirees. Some states tax retirement income that wasn't taxed when earned. Housing costs don't disappear in retirement. Even if you've paid off your mortgage, you still have property taxes, insurance, maintenance, and utilities. These costs tend to increase faster than general inflation, and they hit retirees particularly hard because housing expenses are such a large portion of retirement budgets. Many retirees discover that they can't afford to maintain their family homes, but also can't afford to move. Selling and buying in the same market often nets little cash after transaction costs, while downsizing in a different area means leaving family and support networks. Transportation costs can actually increase in retirement. Retirees often drive more for leisure activities, medical appointments, and errands they use to handle online or during lunch breaks at work. As health deteriorates, specialized transportation or vehicle modifications become necessary. Family financial obligations don't end at retirement. Many retirees find themselves supporting adult children who are struggling with student loans, job losses, or their own financial crises. Grandchildren's education costs, aging parents' care needs, and family emergencies can quickly drain retirement savings. Here's another factor that most people don't anticipate: the psychological stress of living off your savings. After decades of earning money and accumulating wealth, switching to spending down your nest egg can be emotionally devastating. Many retirees become overly conservative with their spending, essentially impoverishing themselves because they're terrified of running out of money. This fear isn't irrational. It's based on mathematical reality. If you retire at 65 and live to 90, your retirement savings need to last 25 years. If you retire at 60, they need to last 30 years. Very few people have saved enough money to comfortably spend down their principal over such long periods, while accounting for inflation, healthcare costs, and market volatility. The 4% rule, which suggests you can safely withdraw 4% of your retirement savings annually, assumes a 30-year retirement funded by a balanced portfolio. But this rule was developed based on historical market data that may not predict future performance. Many financial advisors now recommend 3 to 3.5% withdrawal rates to be safer, which means you need even more money saved. Here's what a realistic retirement budget looks like for many people. If you need $60,000 per year in retirement income and Social Security provides $24,000, you need your savings to generate $36,000 annually using a 3.5% withdrawal rate that requires about $1 million in retirement savings. But remember, that's in today's dollars. If you're retiring in 20 years, you'll need considerably more due to inflation, and that $60,000 assumes no major financial surprises, no long-term care needs, and no desire to travel or pursue expensive hobbies. It's a bare-bones retirement budget by most standards. The cruel irony is that many people work their entire lives, looking forward to retirement as their reward for decades of labor, only to discover that retirement brings new stresses and anxieties they never anticipated. But here's the most heartbreaking part: many of these financial stresses could be avoided or minimized with proper planning. But most people don't get realistic information about retirement costs until it's too late to significantly change their financial trajectory. The myth that retirement equals financial freedom prevents people from doing the hard work of calculating what retirement will actually cost and building adequate resources to handle those costs. It's not that retirement can't be financially comfortable, it's that comfortable retirement requires much more planning and saving than most people realize. The truth: what you can actually do. Now that we've shattered these dangerous myths, you're probably feeling overwhelmed, maybe even panicked. That's actually good. Panic motivates action, and action is exactly what you need right now. The good news is that once you understand the real challenges, you can build a plan to overcome them. Let's start with the most important principle: time is your most powerful ally. Every year you delay starting seriously saves for retirement costs you exponentially more in the long run. If you're in your 20s or 30s, you still have time to build substantial wealth through the magic of compound growth. If you're in your 40s or 50s, you need to be more aggressive, but it's not too late. Here's your action plan, broken down by decade. If you're in your 20s or early 30s, you have the greatest advantage: time. Even small amounts saved now will grow dramatically over 40 years. Here's what you need to do: start immediately, even if it's just $25 to $50 per month. Getting into the habit is more important than the amount. Initially automate your savings, so you never have to think about it. Take maximum advantage of any employer 401k match. This is free money. There's no investment return. That beats the 100% immediate return on your contribution. Focus on Roth accounts: Roth IRA, Roth 401k. While your income and tax rates are lower, you'll pay taxes now on money that could grow tax-free for decades. Target saving 15 to 20% of your income for retirement by your late 20s. I know that sounds impossible, but here's how to get there. Start with whatever you can manage, then increase your contribution rate every time you get a raise. Don't touch your retirement money ever. The penalties are severe, and you're giving up decades of compound growth. Emergency funds should be separate from retirement savings. Invest aggressively in stock market, index funds. At your age, you can handle market volatility because you have decades to recover from any downturns. If you're in your 30s to early 40s, this is crunch time. You're probably dealing with peak expenses: mortgages, children, career advancement, but you can't afford to neglect retirement savings. If you haven't been saving, start now with whatever amount you can manage, then increase it aggressively. You need to save 20 to 25% of your income to catch up. Max out your 401k contributions. If possible, in 2025, you can contribute $23,500 annually to a 401k, plus another $6,500 IRA contribution. Consider a mix of traditional and Roth accounts for tax diversification in retirement. Don't count on your home equity as your primary retirement strategy, but do try to pay off your mortgage before you retire. Eliminating housing payments can significantly reduce your retirement income needs. Start calculating what retirement will actually cost. Use online calculators, but be realistic about healthcare costs, inflation, and how long you might live. Consider term life insurance and disability insurance to protect your family and retirement savings from unexpected events. If you're in your 40s to the 50s, this is when retirement planning becomes urgent. You have 15 to 25 years to build wealth, which is still doable with aggressive action. You need to save 25 to 30% or more of your income for retirement. That sounds extreme, but remember, you have less time for compound growth to work its magic. Take advantage of catch-up contributions. Once you turn 50, you can contribute an additional $7,500 to your 401k and $1,000 to your IRA annually. This is the time to get serious about investment allocation. You should still have significant stock exposure, but you might want to start gradually shifting toward a more conservative mix. As you approach retirement, pay off high-interest debt aggressively. Credit card debt charging 18 to 25% interest is destroying your wealth faster than any investment can build it. consider working with a fee-only financial advisor to optimize your strategy and make sure you're on track. Start thinking about healthcare costs and long-term care insurance. These policies are much cheaper when you're younger and healthier. If you're in your 50s to early 60s, you're in the final stretch. Every dollar you save now is crucial because you have limited time. For growth, max out all possible retirement contributions, including catch-up contributions. In 2025, someone over 50 can contribute up to $31,000 to a 401k and $8,000 to an IRA. Create a detailed retirement budget based on your actual expected expenses, not generic rules of thumb. Track your current spending and project how it might change in retirement. Develop a withdrawal strategy. Work with a financial advisor to create a plan for which accounts to tap first and how to minimize taxes. Consider delay strategies. Every year you delay Social Security past your full retirement age until age 70 increases your benefits by about 8%. Think carefully about geographic arbitrage. Moving to a state with no income tax or lower living costs could significantly stretch your retirement dollars. Plan for healthcare transitions. Research Medicare options, supplemental insurance, and how you'll bridge the gap if you retire before age 65. Universal strategies for everyone regardless of your age. Here are the strategies that can dramatically improve your retirement prospects. Diversify your retirement income sources. Don't rely on any single source. Aim to have Social Security, employer retirement plans, personal savings, and potentially rental income or part-time work. Automate everything. Set up automatic transfers to retirement accounts, automatic rebalancing of your portfolio, automatic increases to your contribution rate. Remove human emotion and procrastination from the equation. Invest in low-cost index funds. High fees can destroy your returns over decades. A portfolio charging 0.1% annually will leave you with significantly more money than one charging 1% annually. Create multiple tax buckets. Have money in traditional tax-deferred accounts, Roth tax-free accounts, and regular taxable accounts. This gives you flexibility to manage your tax burden. In retirement, plan for healthcare costs. Research health savings accounts, HSAs, which provide triple tax benefits and can be powerful retirement healthcare funding tools. Consider long-term care insurance, especially if you have family history of extended care needs. Build emergency funds separate from your retirement savings. Maintain 6 to 12 months of expenses in easily accessible accounts. This prevents you from raiding retirement funds during emergencies. Stay informed about policy changes, Social Security rules, Medicare provisions, and tax laws affecting retirement accounts. Change regularly. Stay informed or work with professionals who do consider alternative strategies. Geographic arbitrage. Your retirement dollars will go much further in some locations than others. Research states with favorable tax treatment of retirement income and lower living costs. Phased retirement. Instead of stopping work abruptly, consider gradually reducing hours or transitioning to consulting work. This extends your earning years while giving you more flexibility. Rental property. Real estate can provide inflation-adjusted income in retirement, but make sure you understand the risks, responsibilities, and tax implications. Part-time work in retirement. If you choose to work rather than being forced to, it can provide both income and social engagement, but plan for this as a bonus, not a necessity. The mindset shifts. You need to accept that retirement planning is your responsibility. The government won't save you. Your employer won't save you. Social Security is a supplement, not a solution. Your retirement security depends on your actions. Start where you are. Perfect is the enemy of good. Don't wait until you can save the right amount. Start with what you can manage and increase it over time. Think in terms of decades. Retirement planning is a marathon, not a sprint. Small, consistent actions compound into life-changing results. Over time. Plan for longevity. You might live to 90 or 100. Plan for your money to last at least 30 years in retirement, possibly 40. Expect the unexpected. Healthcare emergencies, family crises, and market downturns will happen. Build buffers into your plan. Here's your 30-day action plan. Week 1. Calculate your current net worth and retirement savings rate. Use online calculators to estimate what you'll need for retirement. Week 2. Optimize your current retirement contributions. Make sure you're getting any employer match, and increase your contribution rate. If possible, week 3 review and rebalance your investment allocation. Make sure you're not paying excessive fees and that your risk level matches your timeline. Week 4 create or update your budget with a focus on increasing retirement savings. Look for expenses you can cut and redirect toward your future. Retirement security in 2025 requires much more planning, saving, and personal responsibility than previous generations faced. The old rules don't work anymore. Social Security is unreliable, pensions are extinct, and you're on your own. But here's the empowering truth. If you understand the real challenges and take consistent action over time, you can still achieve financial security in retirement. It requires sacrifice, discipline, and smart planning, but it's absolutely possible. The question isn't whether the retirement system is fair or whether it should be easier. The question is, given the reality we face, what are you going to do about it? Your future self is counting on the decisions you make today. Every dollar you save, every contribution increase, every smart financial choice you make is a gift to the person you'll become in retirement. The time to act is now, not next month, not next year, but right now. Your retirement depends on it. Conclusion: we've covered a lot of ground today, and I know it might feel overwhelming, but knowledge is power, and now you have the information you need to make smart decisions about your financial future. Let's recap the 5 myths we've shattered. Myth 1: Social Security will take care of me. Truth: it's facing a crisis and provides barely survival level income, even when it's working properly. Myth 2: I'll just work longer. Truth: more than half of retirees leave the workforce earlier than planned due to health, job loss, or family responsibilities. Myth 3: young people aren't saving enough. Truth: many young people are saving aggressively, but structural, economic challenges make it harder than ever to build retirement wealth. Myth 4: my house will fund my retirement. Truth: while home equity can help, it can't be your primary retirement strategy in today's market. Myth 5: retirement means freedom from financial stress. Truth: healthcare costs, inflation, and market volatility can make retirement more financially stressful than working years. But more importantly, we've given you a roadmap to navigate these challenges successfully. The path to retirement security isn't easy, but it's achievable if you start now and stay consistent. Remember, every person who has successfully built retirement wealth started exactly where you are right now, with a decision to take control of their financial future. Your retirement doesn't have to be a financial nightmare. With the right knowledge, the right actions, and enough time, you can build the secure, comfortable retirement you deserve. If this video has opened your eyes to the retirement planning realities, please give it a thumbs up and share it with friends and family who need to hear this information. Subscribe to Bravo Life 360 for more videos that decode the financial truths that shape your future. And most importantly, take action. Your future self will thank you. Until next time, this is Bravo Life 360, helping you build the life you actually want to live.